Hey, welcome back. Bitcoin is sitting around 71k here in 2026. The fear and greed index is at 15, and I want to talk about something today that most people following this market right now are completely glossing over because all the noise is still about fear, still about macro risk, still about what could go wrong. But underneath all of that, something has been quietly shifting for the past 2 weeks. And if you've been watching this channel, you already know what level we've been tracking, the weekly 200 EMA around 68k. We lost it, we reclaimed it, and now we've held above it for 2 straight weeks. That's not a coincidence, that's a structure. And today I want to walk you through why the pieces are starting to line up, the ETF data, what's happening with Bitcoin mining, and what the chart is telling us about where this goes next. So let's start with a chart, and for the first time in a few weeks, I actually have some positive things to say here while still being honest about what's not resolved yet. The weekly 200 EMA is sitting around 68k. Bitcoin at 71k is now roughly 3k above it. Two consecutive weekly closes above this level that matters. One close can be a fluke, a bounce, a dead cat, a relief rally that fades. Two closes start to look like the level is doing what it's supposed to do, acting as support. The weekly structure is rebuilding, not repaired rebuilding. There's a difference. We haven't reclaimed any major resistance above us yet. We haven't broken out of anything, but the foundation that needed to hold has held for 2 weeks straight, and that changes the probability picture. On the daily, the 200 EMA is still around 88k. We're roughly 19% below it. That gap is actually slightly tighter than it was 2 weeks ago, which means price is slowly grinding back toward it. Still distant, still overhead resistance, but the direction of travel has shifted from moving further away from it to slowly closing the gap. What I'm watching on the chart right now, 72k to 73k, is the next meaningful resistance zone above us. We tested it a few weeks ago and got rejected. If we can push through that level on a weekly close, the air pocket we've been talking about between 72k and 80k opens up. Very little supply change hands in that zone. A clean break through 73k could move fast. 68k remains the floor. 2 weeks of holding, it's encouraging. A third weekly close above it starts to turn the narrative from recovery to trend. Here's what most people are missing right now. While the chart is rebuilding quietly, the flow data underneath it's telling an even cleaner story. Quick one, if you're trading any of these setups, I use BitUnix, clean interface, good liquidity. Link is in the description, by the way. Fear and greed index is at 15, still extreme fear. Compare that to where we were 2 weeks ago when it hit 8, one of the lowest readings this index has ever produced. It's moved from 8 to 15 in 2 weeks. That's not euphoria, that's not even neutral, but it's moving in the right direction, and that slow thaw in sentiment alongside a recovering price is exactly the pattern you want to see at the start of a genuine base building phase. And while sentiment has been recovering, the ETF data has been doing something even more interesting. Spot Bitcoin ETFs just logged their first 5-day inflow streak of 2026. 5 consecutive days of positive flows, roughly 770 million total. The last time we saw a comparable run was back in November 2025. That's over 3 months without a streak like this. Think about what that streak means in the context of the past few weeks. We had a fear reading of 8, we briefly lost the weekly 200 EMA, every headline was about danger and breakdown, and institutional money came in for 5 days straight. The strongest single day of the streak pulled in around $250 million. The weakest day still came in positive. There wasn't a single day of outflows during that entire run. That's not nibbling, that's a coordinated return of institutional appetite. And it's happening while most retail participants are still sitting on the sidelines, deciding whether it's safe to come back in. This is the pattern worth recognizing. Institutions don't wait for fear to disappear before they buy. They buy during it. And by the time fear fades and sentiment turns positive, most of the accumulation has already happened. On the chain, the picture is still sitting in neutral to low territory, MVRV score around 0.4, well away from any danger zone. Nothing alarming and nothing screaming deep value. Just a market that's been correcting and it's now starting to stabilize. But the more interesting story this week is what's happening in the mining industry, because it tells you something important about where Bitcoin fits in the broader technology picture right now. Two separate reports this week painted a detailed picture of what's happening to Bitcoin miners in this cycle. The first is about nuclear energy. AI companies, Microsoft, Amazon, Meta, are now signing long-term power contracts with nuclear plants to fuel their data centers. And here's the thing, Bitcoin miners got there first. They've been tapping nuclear energy for years to run high-performance computing operations. The AI build-out is now following a path that Bitcoin miners already carved out. That's not a small detail. It means the infrastructure that Bitcoin miners built, the power relationships, the energy contracts, the physical facilities is becoming more valuable, not less. The same assets that look like a cost burden during a bear market look like strategic real estate during an AI infrastructure boom. The second report from trading firm Wintermute is more direct. They put out a piece saying that miners who just sit on their Bitcoin as a passive reserve are going to struggle in the cycle. The ones who put their holdings to work, generating yield, pivoting data center capacity toward AI hosting, are the ones who carry a structural edge into the next halving. What does that tell you? The smartest money in the mining space is not treating this as a period to hunker down and wait. They're adapting, diversifying, and building leverage into the next cycle. That's not the behavior of people who think Bitcoin is going away. If you're thinking about positioning around these levels, Bitunix is what I use. Straightforward to set up, good for managing entries when you have an actual plan. Link is in the description, by the way. Macro hasn't dramatically shifted this week, but the direction of travel is worth tracking. The DXY is still elevated around 99. The US-Iran situation is still the main driver of that geopolitical safe haven demand, keeping the dollar firm and applying pressure to risk assets. Bitcoin is holding 71k against that backdrop is usually a quiet statement of strength. A market that's being sold should be lower given this macro environment. The fact that it's not tells you the demand side is absorbing the pressure. The Fed's first rate cut is still priced in for mid-2026. Arthur Hayes, who talked about last week, said he's waiting for the Fed to loosen before he deploys seriously into Bitcoin. That trigger hasn't happened yet, but every week we got closer to it, and when it does come, whether it's a rate cut, a shift in QT, or an emergency response at economic weakness, the liquidity that's been sitting on the sideline has to go somewhere. Bitcoin at 71k with 2 weeks of weekly 200 EMA support, a 5-day ETF inflow streak, and mining industry pivoting toward AI infrastructure, that's not a market that's waiting to collapse. That's a market building a base while nobody is paying attention. That's exactly when you want to be paying attention. Before I wrap up, Bitunix is in the description. Worth having your setup ready before the macro catalyst Hayes is waiting for actually shows up. Here's where I am with this. 2 weeks ago, I trimmed when we lost 68k. Last week, I started adding back when we reclaimed it. This week, with the second consecutive close above the weekly 200 EMA and a 5-day ETF inflow streak on the board, I've continued to build my position gradually. I'm not back to full size yet. I want to see 68k hold for a third week before I'm fully committed, but the direction of my positioning has shifted from cautious to building. Base case 68k continues to hold as the floor. We grind towards 72k to 73k resistance over the next couple of weeks. If that level breaks on a weekly close, the air pocket above it toward 80k opens up and the move could be faster than most people are expected right now. The macro catalyst, Fed counting or shifting, adds fuel to that story when it comes. Risk case, we lose 68k again on weekly close. A second loss of this level would be more significant than the first. It would suggest that the recovery was a dead cat rather than a genuine base. In that scenario, I'd cut more aggressively than last time and wait for either 65k or 60k to show accumulation signals before reconsidering. What I'm watching this week, another weekly close above 68k, ETF flow data continuing to trend positive, any macro developments around the Fed or the Iran situation that could change the DXY picture. The noise this week is still about fear. The data this week is about quiet momentum building. Those two things are going to converge eventually. The question is just which side of that convergence you want to be on when it happens. Drop your levels in the comments. I will see you guys in the next one.